The UK isn't just broke, it's being bled dry by invisible money traps. From hidden taxes to sneaky subscriptions, millions are losing control of their finances without even noticing. The system is designed to look fair, yet quietly drains your income through policies, interest rates, and habits that punish ambition. Every extra hour worked, every pay raise, every easy payment hides a cost that compounds over time. This isn't about bad luck, it's about a structure that keeps ordinary people stuck while wealth flows upward. Let's expose the 10 biggest money traps keeping the UK financially trapped.
Number 1. The 100k to 125k tax trap. Many people in the UK don't realise that earning between £100,000 and £125,140 can push them into one of the steepest effective tax zones in the country. When your income crosses the 100k mark, the government starts withdrawing your personal allowance at a rate of £1 for every £2 earned above that threshold. This means you end up paying an effective tax rate of around 60%. A figure that surprises many professionals who thought higher income would mean better financial comfort. The problem is that this silent threshold acts like a money trap, quietly draining hard-earned income without most people even noticing how inefficient their tax position has become. This trap mostly affects mid to high earners, consultants, managers, and entrepreneurs who often increase their working hours or take on extra projects to reach six figures. Instead of benefiting from those efforts, they find themselves in a zone where every extra pound feels like it's penalized. Even bonuses and commissions can trigger this cliff, leaving people frustrated that their real take-home doesn't reflect their effort. Accountants call this the hidden handbrake of progress, because it discourages ambition while secretly feeding the treasury. Recent figures from HMRC show that more than 1.3 million people now fall into this band, a number that continues to grow as wages rise but tax thresholds stay frozen. To escape this trap, strategic planning is essential. One effective method is pension contribution adjustment, which reduces taxable income while boosting retirement savings. Another option is salary sacrifice schemes that redirect part of earnings into benefits like electric cars or childcare vouchers. Professionals should regularly review their tax code and forecast future income to stay below the critical range where the 60% rate bites. With careful financial strategy and awareness, it's possible to retain more of your money and avoid one of the UK's most expensive income pitfalls. Number 2. Hidden tax and allowance freezes. One of the biggest silent money traps gripping the UK in 2025 is the tax threshold freeze. While salaries have risen slightly to match inflation, income tax bans and personal allowances have remained frozen since 2021, meaning millions of people are unknowingly paying more tax than before. This phenomenon, known as fiscal drag, pulls ordinary earners into higher tax brackets without any official increase in rates. For example, a worker earning £35,000 in 2021 might now be earning £42,000, but due to the frozen thresholds, their tax burden has grown disproportionately, leaving their real income stagnant or even reduced. It's a quiet yet powerful mechanism that has generated billions in extra revenue for the government, often at the expense of average households. The freeze affects not only income tax, but also national insurance, capital gains, and inheritance tax allowances. Families who once stayed below taxable limits are now being pushed into paying for things they never used to, simply because the cost of living crisis forced wages upward. Middle-income professionals, teachers, and healthcare workers are particularly vulnerable because their pay increases barely offset inflation, yet they face heavier deductions. Analysts estimate that this ongoing freeze will pull nearly 4 million more workers into higher-rate tax bands by 2028. The trap lies in its invisibility. People see higher pay slips, but never realize that disposable income is shrinking. To navigate this situation, individuals need proactive strategies. Using ISAs for savings, pension contributions, or exploring legitimate business expense claims can reduce overall exposure. Awareness is power. Understanding this hidden freeze helps protect your earnings and prevent the quiet erosion of your financial progress.
Number 3. The cost of living squeeze.
The cost of living crisis has evolved into one of the most persistent money traps for UK households. Even as inflation rates have slightly cooled, the prices of essentials like food, rent and energy remain far higher than they were before 2022. According to recent data from the Office for National Statistics, the average UK household now spends over 11% more on basic goods and utilities compared to last year. While wages have increased on paper, the real purchasing power of those earnings has fallen. This creates a financial illusion where people feel like they're earning more but can actually afford less. Every trip to the supermarket, every monthly energy bill, and every rent payment now quietly chips away at disposable income, leaving many families trapped in a cycle of just staying afloat. For the working class and middle earners, this squeeze feels relentless. Mortgage rates have doubled since 2021, childcare costs have surged by nearly 8%, and public transport fares continue to climb. Even small luxuries like eating out or taking short holidays have become rare indulgences. The biggest danger lies in lifestyle inflation, people maintaining the same habits despite rising costs, relying on credit cards or short-term loans to fill the gap. Over time, this leads to debt accumulation and diminished savings, deepening the financial pressure. What once felt like comfortable living has now turned into a careful balancing act of survival. Escaping this trap requires a strategic reset rather than random cutbacks. Building a monthly spending audit helps identify silent expenses that drain money unnoticed. Creating a 3-month emergency fund can provide breathing room when unexpected costs arise. Negotiating energy tariffs, using cashback apps, and setting spending limits all contribute to resilience. The key is awareness, understanding that financial survival in today's UK means adapting faster than the crisis evolves.
Number 4. High interest-bearing consumer debt. One of the most dangerous traps tightening its grip on UK households is high-interest consumer debt. Credit card balances, payday loans, and overdraft fees have quietly become a financial burden for millions. According to the money charity's May 2025 report, the average UK household now carries £2,579 in credit card debt, with interest rates averaging above 23%, the highest in over a decade. This means that anyone making only minimum payments could take more than 20 years to clear their balance. It's an invisible treadmill. You pay every month, yet the debt hardly moves. This psychological trap convinces people they are managing fine, while in reality they are feeding a system designed to profit from delay and dependency. The post-pandemic economy has made this issue worse. Rising living costs and stagnant wages have pushed even disciplined spenders into borrowing for essentials, groceries, fuel, or energy bills. Financial institutions aggressively market easy credit with flexible repayment options, but these conveniences often carry punishing compounding interest. Many families now live paycheck to paycheck, paying one card with another and accumulating quiet stress behind polished bank statements. The sense of control is deceptive. Every pound spent on interest is a pound that could have secured savings or investments. This form of debt doesn't just damage finances, it erodes mental stability and long-term opportunity. Breaking free from this trap demands both awareness and discipline. The first step is to pay more than the minimum, even by a small margin. Consolidating debts into a lower interest personal loan can simplify payments and reduce total cost. Avoid using credit cards for everyday expenses and focus on clearing the highest rate debt first. Building a small emergency fund also prevents reliance on credit during tight months. The road to recovery is slow but absolutely achievable with consistent financial control and a clear repayment strategy.
Number 5. Sneaky recurring costs and subscriptions. A major modern money drain in the UK comes from recurring subscriptions and hidden auto-renewals that quietly siphon cash from millions of accounts every month. Digital convenience has made it easier than ever to sign up for streaming services, gym memberships, software tools, and delivery plans, but far harder to keep track of them. According to a 2025 Citizens Advice report, the average person pays for at least 5 active subscriptions, and nearly half admit they no longer use some of them. These small recurring costs seem harmless, $6.99 here, $12.99 there, but over a year they can total hundreds of pounds lost on unused services. Companies intentionally design sign-up flows to be simple while burying cancellation steps behind confusing menus, trapping customers in a web of micro-expenses that silently grow. The trap works because it hides in plain sight. People rarely notice the full impact until they check their statements or face a financial crunch. Subscription fatigue, coupled with automatic renewals, has become a national habit, especially among younger consumers who subscribe impulsively for short-term entertainment or discounts. Even professional households fall victim when work-related tools renew without warning. These expenses slowly erode financial flexibility, making budgeting difficult and draining mental clarity about where the money actually goes. Each forgotten charge represents missed opportunities to save, invest, or simply breathe easier at month-end. Escaping this subtle trap begins with a complete subscription audit. Reviewing your bank statements quarterly helps identify dormant payments. Using digital tools that track and cancel unused subscriptions can reclaim hundreds every year. Setting a calendar reminder before renewal dates puts control back in your hands. Prioritize what truly adds value to your life and eliminate the rest. Every cancelled subscription is not deprivation, it's liberation from the illusion of convenience that quietly costs more than it gives.
Number 6. Buy now, pay later, and easy credit temptation. The rapid growth of buy now, pay later services has created a powerful psychological trap for many UK consumers. Platforms like Klarna, ClearPay, and Lay-Buy promise instant access to products with the freedom to pay later. Yet behind that flexibility hides a growing culture of silent debt. Recent data from the Financial Conduct Authority shows that over 15 million Britons have used Buy Now, Pay Later in the past year, with nearly 1 in 5 already falling behind on payments. The illusion of affordability fuels impulse purchases, especially among younger buyers seeking to manage rising living costs without feeling restricted. Each small payment seems harmless, but when multiple purchases overlap, they snowball into a financial burden that becomes difficult to track or repay. The trap deepens because buy now, pay later services don't feel like traditional loans. There's no paperwork, no visible interest, until a missed payment triggers penalties and credit score damage. Retailers benefit immensely as buy now, pay later boosts sales by reducing buyer hesitation, but the consumer often ends up juggling several mini-debts across multiple platforms. Many people use buy now, pay later to cover clothing, groceries, or gadgets, blurring the line between necessity and indulgence. The danger isn't in one transaction, it's in the pattern of delayed accountability, where short-term comfort quietly replaces long-term stability. By the time overdue notices appear, the debt cycle has already begun. Avoiding this trap requires conscious control rather than guilt. Treat buy now, pay later like any other formal credit agreement with the same caution you'd apply to a bank loan. If you can't pay for it in full today, reconsider whether it's worth buying at all. Track every installment in a budgeting app and limit buy now, pay later to essential or planned purchases. True financial freedom doesn't come from delaying payment. It comes from reclaiming discipline over every decision you make with your money.
Number 7. The first-time buyer snag and frozen limits. For many young adults, the dream of owning a home in the UK has turned into a financial trap disguised as opportunity. Government schemes such as the Lifetime ISA were created to help first-time buyers save efficiently, but outdated rules have left thousands locked out. The property price cap for eligible homes remains frozen at £450,000, a limit that hasn't moved since 2017, despite house prices rising by more than 35% in major cities like London and Manchester. As a result, savers who spent years building deposits now find their chosen homes disqualified. The very system meant to assist them ends up penalizing their progress. Many are forced to withdraw savings, paying heavy penalties and losing the 25% government bonus that once made the scheme attractive. This trap exposes how government policy can unintentionally widen the housing gap. Rising construction costs, inflation, and mortgage rate hikes have made even modest properties unaffordable, while frozen support thresholds keep genuine buyers waiting on the sidelines. For those earning moderate incomes, the frustration is immense. They've done everything right, saved diligently, avoided debt, and followed the rules. Yet policy stagnation turns discipline into disappointment. Housing experts warn that without updated thresholds or better affordability schemes, the UK risks losing an entire generation of homeowners, deepening dependence on private rent and exposing families to lifelong financial instability. To avoid falling into this policy-made trap, first-time buyers should explore shared ownership, help-to-build programs, or credit union mortgages that offer flexibility. Consulting a financial advisor before committing ensures that savings align with eligibility requirements. Checking government updates and using affordability calculators can prevent years of effort from going to waste. The key is adaptability. Staying informed about changing limits, market shifts, and financial tools that can transform a blocked path into a sustainable route toward real ownership.
Number 8. Benefit reductions and debt deductions eat in support. Another hidden financial trap affecting millions across the UK lies within the very system meant to provide relief, the benefits and debt deduction structure. Many low-income households receiving universal credit or other forms of support find their payments quietly reduced by automatic deductions. These deductions often repay old government debts, like overpaid benefits or advanced loans, but they can strip away as much as 25% of a person's allowance each month. According to research from the New Economics Foundation, more than 2.2 million families are now caught in this cycle, losing an average of £31 monthly through deductions alone. The result is a cruel paradox: financial aid that fails to aid, pushing vulnerable individuals deeper into dependency and hardship. The emotional toll is immense. Families budgeting to survive find their expected payments short, with little explanation or warning. This unpredictability makes it impossible to plan for essentials like rent, food, or transport. Many turn to high-interest lenders or credit cards just to cover shortfalls, creating a secondary debt spiral directly linked to the benefit system. For those already struggling with the cost of living crisis, it becomes a relentless tug-of-war. One hand of the state gives, while the other takes away. The problem is worsened by complex bureaucracy that leaves recipients feeling powerless to challenge unfair deductions or administrative mistakes. Escaping this trap begins with information and advocacy. Claimants should check monthly statements through their online universal credit accounts and contact the Department for Work and Pensions for explanations of any unexplained deductions. Charities such as Step Change and Citizens Advice offer free guidance to help renegotiate repayment plans or pause deductions in hardship cases. Financial empowerment starts with awareness, knowing what's being taken, why, and how to reclaim control over what rightfully belongs to you.
Number 9. The minimum payment cycle. One of the most deceptive money traps in the UK is the minimum payment cycle tied to credit cards. It lures consumers with the false sense of staying on top of their debt, when in reality, they're sinking deeper each month. Credit card companies highlight small minimum payment amounts to make bills look manageable, often just 2 to 3% of the balance. Yet paying only that minimum means the majority of your money goes toward interest, not the actual debt. The Money Charity reports that a person with £2,500 in card debt paying just the minimum could take over 24 years to become debt-free and pay more than double the borrowed amount. This structure benefits lenders enormously, locking customers into a decades-long repayment loop that feels safe but costs a fortune. The trap feeds on psychological comfort. Seeing minimum payment due gives the illusion of responsibility, especially when money is tight. But this comfort masks the real danger. Interest continues to pile up, even as the principal barely moves. Over time, the balance becomes harder to manage, and any emergency expense can send it spiraling out of control. Many UK households juggle multiple cards this way, rotating debt while unknowingly feeding an industry built on financial inertia. What begins as convenience slowly transforms into an invisible burden, draining wealth silently, year after year. Breaking free from this pattern requires a mindset shift. Always aim to pay a fixed, higher amount each month, even if it's modestly above the minimum. Prioritize cards with the highest interest rates first to reduce long-term costs faster. Setting up automatic overpayments ensures consistent progress without mental fatigue. Awareness turns the minimum payment cycle from a lifelong trap into a short-term challenge that disciplined effort can overcome permanently.
Number 10. Investment and scam risks targeting vulnerable savers. The UK has seen a surge in investment scams and high-risk schemes preying on people desperate to grow or protect their savings amid inflation and economic instability. Fraudsters have become sophisticated, using professional-looking websites, fake financial advisor profiles, and cloned investment firms to appear legitimate. According to the Financial Conduct Authority, British consumers lost over £97 million to fraudulent investment and crypto schemes in just the first half of 2025. Victims often include retirees or middle-income professionals seeking better returns than banks offer. The promise of quick profits, guaranteed yields, or exclusive opportunities lures even cautious individuals into transferring life savings to criminals. Once funds are sent, recovery is nearly impossible, making this one of the most devastating modern money traps. The scam epidemic thrives on emotional pressure and lack of regulation in newer markets like cryptocurrency and forex trading. Scammers use fear of missing out and authority cues such as fake celebrity endorsements or fabricated FCA registration numbers to create trust. Many victims realize too late that they were dealing with unlicensed brokers or Ponzi-style operations. Even genuine high-risk investments can act as traps when people invest without understanding volatility or liquidity limits. What seems like ambition can quickly turn into a financial disaster disguised as opportunity. Avoiding this trap demands skeptical diligence. Always verify any investment provider on the FCA's official register before sending money. Be wary of unsolicited calls, emails, or social media ads offering extraordinary returns. Genuine financial growth takes time and transparency, not urgency and secrecy. Consulting a certified advisor or using established UK-regulated platforms ensures safety. In an era of digital deception, awareness is your best investment, protecting both your savings and your future stability.
The truth is, financial struggle in the UK isn't accidental, it's systemic. From frozen tax thresholds to easy credit schemes and stealthy subscription charges, the economy is quietly engineered to keep people paying more while owning less. These traps thrive on routine and distraction. The less we notice, the more they take. But awareness changes everything. Once you start tracking your money, questioning every small cost, and planning with intention, you begin to step outside the cycle. Real wealth isn't just about earning more, it's about protecting what you already have from silent leaks and avoidable losses. No government reform or economic shift will save you faster than personal financial awareness. Whether you earn 25k or 125k, the key to freedom lies in understanding where your money truly goes. Start small, audit your subscriptions, review your tax code, and avoid high-interest debt traps that quietly erode your effort. Every pound saved is a pound of power reclaimed from a system built to consume it. If this video opened your eyes to the hidden traps shaping your finances, hit the like button and subscribe for more deep, practical breakdowns on money, policy, and survival in today's UK economy. Share your experience in the comments. Your story might save someone else's wallet.